Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, May 3rd, 2019. Let's mix things up a little bit and change of view here today in this video. I wanted to go over the global markets, not a lot, just the major developed markets. So just a handful there, maybe a half a dozen charts, plus the U.S. as well. We'll start out here with the U.S. And actually, as I was going through these, I have a lot of those charts saved on a different charting platform than I usually do in the video. This is stockcharts.com. And I actually ended up going through, recycling through some old charts I haven't pulled in a long time. I've got just tons and tons of charts, and some of these charts I hadn't updated for quite some time, even a couple of years. So let's go through these and just start out with the U.S. markets. Really nothing new here, but from a longer term perspective, as we are testing the highs again in the U.S. markets today, this is just the bigger picture. This is a weekly chart of the Nasdaq 100, and you can see we had pretty much two primary trend lines and two major corrections during the bull market off the lows. We had this really about a 2-year sideways grind and a near bear market back here in 2015. In fact, a lot of sectors and indexes like the small and mid caps, they hit bear market status just as we did back here. But the point being, and you can see it right up here, divergent highs, and again on a weekly time frame, they almost always lead to major tops. There was that's the bear market, the 55% drop. It doesn't look like much here on this scale. I'm using log scaling. But there was the last bear market, and so then this bull market set up really into two phases. We had this first multi-year leg up into those 2015 highs with a lot of like I said, a nearly 2-year sideways consolidation with several sharp corrections in there, and then that led to the thrust up here, largely induced by the Trump pump, the change in Washington, and that set up a well-defined trend line off the lows in early 2016 on a lot of indexes and sectors, and those are the trend lines that were recently broken in the fourth quarter and back tested here. In fact, we're back testing right now. So there's the divergence that we've had. We had again, divergence leading up to that first drop, and not only have the divergences not been negated or taken out, meaning that the indicators would move higher, they've only extended, just like they did back here. You had a couple little shots across the bow. Sometimes you get those smaller divergent highs, you get the first correction, and then finally the bigger correction comes. And usually what will happen is the first divergences will usually take you back down to the trend line, some cases below. In this case it took us below, and again we're back testing, and we did back test there real quick. Alright, so let's move away from this. You've seen that one plenty of times. Let me grab the S&P 500, and then we'll move on to a couple of charts I haven't showed in a while. Here's another view of the entire bull market with the broad market here, the S&P 500. So you have your lows back here in March 2009. You had a, we'll call it a minor uptrend line that was broken back in 2015. That multi-year sideways trading range back there, you can see from lasted a while where the market pretty much traded, had that correction. But what we have here is the primary bull market uptrend line that comes off the lows here in 2009. That's the one we're looking at now. So that's it. That's just big picture stuff, and these weekly charts can take months and even years to play out. And so right now we don't have confirmed divergence. Why? Because the indicators are still heading higher, and they could continue to go up. But as of now, we had a divergent high back there in the October of 2018. Followed by that sharp correction that also took out the bull market uptrend line. We consolidated below it after we broke down. We back tested for several weeks, you can see there, and then boom, big thrust down. And it's taken us this long, and again, because you're talking a 10-year bull market, so bigger picture, that's it. Breakdown, back test, and we're getting close, not quite overbought, but very steep divergences. And as I mentioned back then, this was the most overbought either the S&P 500 has ever been in its history. I went back, I think, 30 years and couldn't find an overbought reading that high on the weekly chart, and that was that triggered the first correction back in 2018. And then, like I said, we've just been building divergences since then. So that's just kind of bigger picture stuff. Not actionable as far as trade ideas, but if we start to roll over and move impulsively lower soon and confirm the divergences, then that will that will speak to the longer term outlook. And of course, if we take back the trend lines, take out the divergences, everything else, break out the new highs, everything I talked about, maybe consolidate, and there's certainly room for that to happen. And if so, then the technical outlook will change. Okay, I dug up this little gem, or maybe a potential gem. I had not updated this chart or even brought it up since back in, looks like 2016 was the last time I mentioned this. And what you're looking at here, this is the S&P 500 with the candlesticks there, and I overlaid cycle lines. It was something I'd been tracking a few years back. And as you can see here, these cycle lines are spaced 3 months apart. Now it's not exactly 3 months, because when you enter cycle lines at least on StockChart.com, you have to pick the number of periods. You can see down here, so I picked a period of 63 periods. It's a daily chart, meaning 63 days, because there's, on average, it's not exactly 30 days in a month. Otherwise, we'd have an even 60 days there. Actually, let me clarify. 63 trading days. Of course, there's 90 days in a quarter, but these are trading days, because of course you don't have the weekends. So as you can see here, here's the hash marks. There's 2015. There's the cycle line at the same point every year thereafter. So they're quarterly cycle lines, but they're not perfect. And I'll show. So here's where I'm going to get with this. So you can see here that peak earnings week, by the way, is what I referred to as, we just had the last of the two FANGs. So we all had in the last 2 weeks here, we've had all 5 market leading FANG stocks report, and those are by far, they make up the bulk of the market cap, the top components of the S&P 500. So with Apple and Alphabet both reporting the last of the 2 this week to finish up, I consider us now over the hump. So this is peak earnings week, and you can see. So basically what this chart shows is a lot of times you look for, these are inflection points. See where these lines hit back then. Inflection point is you have a trend going one way, and it cuts both ways, but usually you're going to have an inflection point when you're going up. There was a period we didn't correct right away, but you can see there's a lot of inflection points there on those lines. Some of those are circled. Here's a really big one. So it looks like back here in 2014, the market sold off very hard, worried about earnings. In a peak earnings week, everything changed. The market liked what it heard and rallied from there and didn't stop really till up here. Okay, so you can see here, same story. We had the market peaked. That was actually the top right there before that huge correction and near bear market, or bear market in some indexes, and it was marked to the button with peak earnings week right there. And where did it end? Exactly on peak earnings week. That's where the worst was over. I mean, we tested the lows once again, but if you can make it out, there is a candlestick there. I don't know if you can see it in the video, right to that lows, came in right at peak earnings week. And again, another inflection point. Here we peaked, went up a little bit, rounded out. So it doesn't work every single time, but when you get the big trends. Now, what we need to do is, because again, there's not exactly 63 trading days in every quarter, over time these lines are going to shift. So that's what I need to do right now, is shift them over for you. Go into annotation mode here and shift those over, because again, here we're peak earnings week right now. It's a daily chart, so we're a little bit past there. So you can see these lines line up almost perfectly now with some of the recent major inflection points. So let me save that. Stock Charts is a very antiquated, clunky trading platform. You have to enter annotation mode. So you can see right here, that was the high back there. Remember 2018, we had a blow off top, market was roaring, everything was great, earnings were going to be great, but the market didn't like what it heard. That was peak earnings week right there. And you can see here, didn't happen there. We sold off down into earnings right here and had a major inflection point. A sell-off ended right there, a big bounce, but it didn't do the trick. Either way, take it for what it's worth. As I said, you're not going to see inflection points each and every time, but sometimes, especially after an extended run or an extended drop, that's what you want to look for. And we've certainly had an extended run up into this peak earnings week. So Only time will tell. We'll know going forward if there's going to be an inflection point after this week, but that's what the lines look like here. Again, shifting most importantly this line now to the current week, so that should then come in roughly with those last, at least the last half dozen or so peak earnings weeks every at last few quarters. Here's another one I dug up. I haven't shared this in a while. You'll see me use Fibonacci retracement levels every now and then, sometimes Fibonacci projections. These are what are called Fibonacci fan lines, and the way they work, so it's cut off here. I can't go back. I had it originally set on the previous bottom of the last bull market there, but what happened is you can see here you get these fib fan lines, and again, we can't see this one too well right now. Let's just focus on the last couple bull markets here. So you had a bull market that started back here down in late 2002. That was after the dot-com bubble. There's the bear market. And so what the fib fans do is a pretty good job. You can see there's like a series of uptrends, different various uptrend lines within each bull market. So I put the fib fan lines on the bottom, the beginning of the bull market or the end of the bear market. And usually in a bull market you have an initial thrust, a very strong advance. That's a steep trend line. That trend line breaks, and then you can see we come into play, and it's not perfect here, but it does a pretty good job. So that was the final fib fan line right there in 2007, and once that one was taken out, and you can see it did a good job of acting as support, a lot of tests, and once that fib fan line was broken for that bull market, that's all she wrote. And then so we started the next one down here early 2009, March 2009, when the bear market ended and the bull market started, and same story. So you had this uptrend line, you can see it was or fib fan line I should say, market caught support on that initial very strong thrust up, came down, fell, found support on here, and then tested it from below once it broke it. So you can see the reactions off there, and hugged this one for a while, finally broke that one. And so usually once you break one, you move down to the next fib fan. That's the next support line, as we did here. Danced on it, danced on it, danced on it, danced on it, and then finally broke it. So that's that's interesting. We'll see what happens. So we're not quite back testing, but we are back testing the trend line as I had it drawn on those other charts a minute ago. Couple more before we get off the U.S. markets, because that's where most of us are trading. But I do want to get to the international markets here, and I will in a second. This is a long-term, 20-plus year chart of the Nasdaq Composite. So often we're looking at the Nasdaq 100 because that's what's the tradable vehicle. They're tracking ETFs and funds and futures for the Nasdaq 100, but those are just simply the 100 largest stocks within the Nasdaq Composite. So if you want to include the entire universe of the stocks in the Nasdaq Composite, this is it. And you can see this chart's pretty clear. You've got the 2000 top was a bubble. It went parabolic. This is a parabolic run. You had to have a parabolic trend line to capture that one. But most bull markets have a nice, clear, well-defined uptrend line. So there was your 2000s, 2002 to 2007 bull market. There's the Great Depression and the Great Bear Market there. Nice positive divergence at that low. That said it was over. That launched the bull market there. And you can see we set up again in two trend lines. We had this initial uptrend line that was broken back in 2015, big sharp correction, almost 2 years of sideways trading really from this point here to that point before we finally broke out right here. And there's that other trend line right there off the 2016 lows. And again, you can see down here what this chart has in common with a lot of others is each of those bull markets. You're looking at the three bull markets over the past 20 plus years, and they all ended with the same thing, and negative divergence. Now we had divergence between. It didn't lead to bear markets, close here but not exactly. But I just wanted to point out this time again we had the most extreme. The only time the Nasdaq Composite has been this oversold as it was back in early 2018 was back there at the dot-com bubble when everything went parabolic. So supersized bull market back then. This is the only one that you can really compare to that one. And supersized bull market this time around, supersized divergences. So they haven't played out yet. The small divergences played out for that drop that we had last quarter. But again, they're still building right now, and only time will tell if that's if they're going to play out for the next leg down or not. Okay, we'll start out here with the Australia All Ordinaries Index or Composite. These are long-term charts, so we're just going to look at weekly charts because that paints a big picture. You know, you can see going back in time, same old, same old. You have these divergences, and again, more often than not, they play out. We had divergence there. These are the corrections measured in percentage terms: 12%, 15, almost 16%, and then a lot like now, you have a series of consecutive divergences, each being resulting in their own correction, and then finally, when you have an extension, continued divergences that build over time and only steepen, especially when they start to drop off like that, boom, that's when the big one comes. So you can see, so going back in time past, what is this, 15 years or so on this chart, there haven't been that many. You have these, you know, they've extended, but you've had these divergent highs. There's a 25% drop, another divergence. Now, and again, this isn't, all this stuff is not hindsight. In fact, you can see right here, the last time we had a bear market, this time around we didn't hit it in Australia. We had a 15.6% drop. Last bear market was right here, peaked right there in early 2015. So again, this is stuff that, you know, it's pointed out in advance, and these things play out. This was a post from back on March 31st, 2015. Australian stocks poised for a bear market. The case was made, everything was laid out, it was ready to go, primed for the move, the divergences were confirmed, and again, so flipping back to the current chart, that's where we were, right here at that point in time. And so that one played out for a 20.4% drop. So we got that bear market target, you know, hit 20% drop, and then from there, it's when you go long, you get these bullish divergences, just like we had back in a lot of the U.S. indexes and sectors in December. It's just wash, rinse, repeat type stuff. So here's the bull market uptrend line right now. Let's forget about what's happened. Let's just look at what's happening right now. This is diverging, just like the U.S. markets. We had that first divergent high, led to a 15%, almost 16% drop, we'll call it. And that looks to me like the shot across the bow, come back up, perfect back test right now with the trend line. So we have a lot of, you know, the U.S. markets and some of these major overseas markets back testing right now with the divergences still very much in place. So we'll see what happens from here. Well, next up is the DAX, German DAX. This is a pretty clean chart. I don't have a lot of annotations, a lot of trend lines, a lot of measurements. Just one clean, well-defined uptrend line off the lows, 2009. That's your primary bull market uptrend line. Lots of clean reactions. And very clear negative divergence, steepening right at the highs. In other words, you had divergence, and then right at the end there, it started coming a little more steep, dropping off there, and that marked the high. And so far, that was a high, and we've been moving down. We're still well below trend. So this is an index in a bear market, and if you're an Elliott waiver, maybe that's wave A or wave 1 on a 5-wave primary, 2, 3, 4. I don't know. I'll have to look at that. I'll leave that up to the Elliott EW experts there. But either way, we're below trend and still very much off the highs in the DAX, which is also the common theme here. It's really just the U.S. markets that are punching new highs, and Canada. We'll get to Canada in a second here. Just a couple more to go. And next up, the French CAC 40, if I didn't butcher that French there. This is the leading index in France. Weekly chart, you can see right now, of course, same story, all the divergent highs, followed by all the corrections in the past, and here we are. So we had a divergent high correction. You know, it's a $1 million question too, guys. Is this, was that it? Was that enough? Maybe the divergence is over. Again, like I said, they're not confirmed right now, and we can continue higher, and sometimes divergences are burned out. However, until they are, we have near overbought conditions coming up, and again, a lot of times you get that initial correction right here. For example, though there was a divergent high there, you don't see it drawn out here. You had a line right here. That was your initial divergent high right there. Shot across the bow. We pushed back up. The divergences continued to extend, and then that was it. So that's what we may have here, or we could continue to burn through those. But I just wanted to point out that the story is very similar, at least the technical posture in a lot of the major stock markets around the world, very similar right now. Okay, here's the Japanese Nikkei index. If anything, this is probably, we're going to maybe see a similar situation in the U.S. We have a lot of parallels to Japan's housing slash debt bubble that they had back in the 90s. They answered with the same thing we did now: quantitative easing, money printing, led to zombie banks and a zombie stock market economy. As you can see here, over 2 decades, Nikkei's gone virtually nowhere. They're trading right about now, today, where they were back in the late 90s, early 2000s. So now, what stands out on this chart? Here it is. This weekly chart of the Nikkei spans 20 years with each of the 4 bear markets right here preceded by divergent highs. Bear market 1, bear market 2, bear market 3. Well, that's actually, yeah, it was a 20% drop there, but there's another one, so we'll call it 1, 2, 3. Yeah, I got it right, 4. And now here's 5. So will this one be different? That's the question. So far, it's playing out. Nothing goes straight down. I'll erase those lines real quick. You can see here. You get kickback rallies along the way. That's part of a bear market. If this is one now, the next one in the Nikkei. So all I can say is we had a pretty clean up trend line. It was broken. We had the divergent high. And look, it works in reverse too. I'm not a perma bear. And these are the divergent lows. This is where you look. I'm looking forward to something like this over the next 10 or plus years in the U.S. market. Maybe a big sideways range with bull and bear markets within. It's very tradable. The Nikkei was very tradable back then, and has been since. Okay, we just had the closing bell for the market. Let me cover, what else did I miss? Well, let's do Toronto real quick for the Canadians out there. The TSX, that's the Toronto Stock Exchange, is similar to US, where it's pushing up and just barely taking out the previous highs from back in 2018. And it's also, like the US, doing so with some divergences in place. So one to watch. Again, going to burn through the divergences maybe. You can see there's just been a series of divergences, each with their own corrections. And the corrections are actually increasing in magnitude so far, and that makes sense. You have divergent high 1, the divergence extends, bigger correction. Divergence is extended again, will the next drop be even bigger yet? So we don't have a very clear uptrend line. You know what, let me see if I have an uptrend line here on the daily chart of the TSX to watch. But that's what you typically want to watch, because again, divergences, like I say, can go on forever or a long time before they play out, or they can get taken out. So what you really need is a sell signal, and that comes either in some form of candlestick reversal pattern or trend line break or a bearish chart pattern breakdown. Okay, good. I do have a TSX daily marked up. All right, here we go. This goes back to 2016, and there it is. Divergent highs. Some of them are small, about a 4% drop. Another divergent high, 7% drop. Another divergent high, 10% drop. Divergent high. You can see all the divergences down here on the indicators. I should have had that line like that. There's a divergence line right here. So 1, 2, 3, 4, 5 divergent highs. Will this time be any different? I don't see why it should be. It's possible those divergences again could be burned out, but look how steep they are. Very steep daily divergences here. There's a potential. This might be the trend line to watch here. It's not we don't have a lot of reactions on it, but if you're trading the Canadian markets, keep an eye on that. And you can also see that they backed off the highs. This one is going to be an end-of-day chart. It's not going to have yet reflect today's. They'll update this chart in about an hour or so. So this is as of yesterday's close here, I believe, on the TSX on stock charts. But that's what we're looking at there. And like the U.S. markets is a strong divergent low, and this was the time to be bullish back here. And nobody wanted to, most people don't want to buy stocks after this. They think the world's coming to an end, and right now everybody wants to go long. And you have to, if you had an all clear signal, sure. I don't think there's an all clear signal in the market, but we'll see. So we'll wrap it up here. I believe that's everything I wanted to cover, and if I missed anything, I'll just follow up with maybe a static chart below this post. Keep in mind too, if you get these emails as a member of the site, A lot of times I'll go in after I post a video or individual charts, and I'll add additional charts or comments in the comments section. So it's a good idea to come in the site if it's something you're interested in, and I may sometimes post some follow-up charts or comments there. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.